Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. My guest today is Phil Price. Phil is an enrolled agent. He's licensed to represent clients before the Internal Revenue Service, but mostly he has his own pension consulting firm called The Price Company, which serves small businesses, I guess, is it throughout California?
California, clients in Florida.
Wow, Florida.
Wyoming.
Oh boy.
Oregon.
You have my sympathy.
So.
Okay. Anyway, the Price Company, Phil was telling me, was actually started by his father back in 1971,
Right.
back in the Wild West days before pension reform in 1974. And then Phil bought his father out in 2001?
2000.
2000, excuse me, okay. So anyway, so it's been his show since then, and so Phil and I have had opportunities to work together, and I felt that he had something worthwhile to share with everybody here, or our viewers. Today we're going to be talking about retirement plans for closely held businesses, and we're going to be talking about some of the alternatives that are available and so forth. Before we get started, I just want to remind our viewers that this is a complicated area. It takes years to study this stuff, really, to know it. And so we're only going to hit some highlights, and hopefully get the appreciation for people like Phil that can help you in implementing these plans for your own business. Phil, thanks for joining me today.
Thanks for having me.
Oh, great. Okay, well, why is retirement planning important for the owner or owners of a closely held business?
Well, there's a few different reasons to have it. An important one is to be competitive in the workforce for good employees.
Mm-hmm.
Another is to be able to take profits out of the business and save them for the owner's retirement.
Mm-hmm.
The last survey out there about baby boomers, only $50,000 as average has been saved for retirement. And
That's pretty sad.
Yeah, that's not a whole lot. So
Uh-huh.
it's important for everybody to have a retirement plan and be able to save money.
Yeah, especially these days. I mean, all of us are concerned about Social Security and so forth. They're raising that retirement age,
Right.
and anyway, so Social Security was never intended to be the whole be-all for
No, it
retirement
wasn't.
anyway. And so any way that we can do it. Now, there's another thing that's coming up. So now we've had this decision from the Supreme Court related to healthcare reform.
Correct.
And so there is a nice tax that's coming up that's supposed to be effective next year, unless Congress does something about it. It's a 3.8% tax on investment income for people that have more than $250,000
Correct.
of adjusted gross income if they're married, and then $200,000. So those numbers are there that Obama's been talking about. We really do already have an increase that's scheduled, and that's a pretty significant increase.
Yes.
Plus the uncertainty related to the tax laws in general. But really what my point is that pension benefits aren't subject to that tax.
No. And the capital gains inside
Yeah.
a retirement plan are not subject to that either. So any capital gains or gains you have inside a retirement plan are not subject to that 3.8%.
Right. Well, there's a trade-off because you don't get the capital gains benefit
Correct.
either. So anyway, so we'll be talking about different approaches to this and so on, but there's a few anyway to think about. All of us, we've got a graying of America, baby boomers. I think you and I are both there.
Yes.
And so getting close to retirement age, there are actually things that can be done to accelerate some funding. I don't know if we'll have a chance to talk about that very much, but we know that there are some bonus contributions, for example, that can be made. We'll maybe talk about that. So anyway, it's a little late. The sooner you do this, the better. All right. Well, why don't we move on a little bit? What are some of the basic types of qualified retirement plans. And maybe you can tell us a little bit about the basic information, what kind of contribution limits apply for them, basic advantages and disadvantages for each of these different types of plans.
Well, there's individual retirement plans, IRAs. There's also a SEP IRA, which is basically an employer-funded IRA. Once it's funded, it's in the person's IRA. They can do what they will with it. There's qualified retirement plans, which include a profit-sharing plan, a 401k plan, pension plans, employee stock ownership plans, and then there's defined benefit pension plans, which look and sound familiar to the way Social Security, they pay a benefit at your retirement. It's a classic pension plan that companies would give you, back in the old days. But they're still around.
Right. So there's a few, but they've sort of become dinosaurs for the major companies. So this is like the plan that maybe your dad had his own pension company, but my father worked, for example, for Lockheed Missiles in Space.
Right.
And my father-in-law worked for the Navy Department. So anyway, they had a retirement plan that basically it was going to pay a fixed amount benefit after they retired, and then maybe have an adjustment for inflation or something like that built into it. So that's the traditional retirement plan. Again, most companies have decided that those are too expensive.
The big ones are.
They've moved to the 401k model. And the ones that I've seen or heard mostly about for defined benefit are usually professionals, particularly like doctors and dentists, that they're looking to shovel a lot of money into these.
Right.
And so they can fund a big retirement benefit for themselves. The issue, again, is if they have employees, then they have to deal with
the cost there.
Yeah, the cost there. They can't be discriminatory, or there's limitations on how discriminatory they can be. So maybe you can talk a little bit about, okay, like an IRA, we got $5,000 that we can put into that?
Yeah, $5,500, I think.
And then we've also got, again, an additional like $1,000 that we can put in, like if you're over 55.
Right, a catch-up.
A catch-up. And then now the simplified employee pension, we have the same limit that applies as for a profit sharing plan.
Correct.
And that's
it's 25%
of
the eligible compensation that can be put in,
and
to a maximum of $50,000 on an individual basis.
50,000, and then we've got to catch up there too. What is it, 5,000 or so?
If you're in a 401k plan, you can have a catch up, and that's $5,500.
Okay, and the 401k is sort of a variation on the profit sharing where the employee gets to voluntarily, supposedly, put a certain amount in. Was it about like 16,500 or so?
17,000 for 2012.
I guess I'm a year behind.
Yeah. Well, it was 16,500 for about 3 years. So.
Yes. Okay. So it was 17,000, and then we said that we had again the catch-up contribution there.
Yeah, that's for somebody that's 50 and over.
Okay.
It's the catch-up.
Okay. Yeah. Now, another thing then related to these is that we've got this Roth alternative.
Correct.
Now that applies for the IRA and for the 401k for the employee part.
Correct.
Okay. And the Roth means that there's no tax deduction that applies for the money that goes in, but when the benefit is paid out, if you meet certain requirements, then there's no tax that applies.
Yeah, no tax on the back end.
Yeah. So it's an interesting new alternative, a new twist. It was actually, I think, a revenue-raising measure for the government. They're
might have been
looking for a way to incent people to save without getting a tax deduction. And in some cases, if they do a conversion, like of an IRA account or whatever, then I think you can do it with a 401k as well. Anyway, if you elect to do the conversion, it means you're accelerating taxes.
Yeah, you're paying more now, and ideally, with the investment gain, it'll pay off on the back end. You're not having to pay.
Now, the other thing related to these is we do have some mix and match that's available for these plans.
Yes.
So, for example, you could have a profit sharing plan and a defined benefit plan, but there's special limitations that apply.
Right, and in fact, you know, before you were discussing about the defined benefit plan and some of the employee costs, and that combination plan is something that we're doing a lot of, where you have certain employees in the defined benefit plan. And the owner and that type of thing. And then you balance everything out in the profit sharing or 401k plan to balance the benefits out and make sure everybody is meeting all the testing that the IRS has. So there's no discrimination.
Right. So there is one thing about these, I guess, that I guess we're going to talk a little bit more later, but there is testing that's involved.
Yes.
And so when a business is thinking of adopting these, we have different levels of compliance, and that's what makes some of these seem more attractive at certain stages. So, for example, we talked about the SEPs, the Simplified Employee Pension Plan, which is, again, it's an IRA, but it has limitations like for a defined contribution plan, like a profit-sharing plan. But the compliance requirements are a lot simpler. The only thing beyond that, though, is that it's like non-discrimination on steroids. Everybody's got to participate in the same
everybody
percentages.
above, gosh, I think it's about, if you
Age
make
21.
you get paid over $300.
Yeah.
And you've been there 3 of the last 5 years, it's approximately $300 some odd dollars, and you're in, as opposed to having to work 1,000 hours to be in a profit sharing.
Yeah.
And also, once the money's put into the SEP IRA, the people can go and have access to it, whereas in a profit sharing plan, they have to terminate service or have something like that to have access to it.
Right, and again, I mean, when you put this money into a simplified employee pension, it's the employee's money. That's it.
So
it's fully vested.
Yes.
Whereas with a profit sharing plan, or any plan where there's an employer contribution, besides this, for the most part, then there's going to be some sort of vesting that is a possibility. So that if the employee doesn't have a certain number of years of service and so forth, they could actually lose some of their benefits.
Yeah, they don't receive their entire account.
Right, right. Okay. Well, how do you go about having one of these plans created? What are some of the different ways that you can go about that?
Well, you have to set up a plan document. You know, if it's an IRA, you just go in with a custodian, stock house or an insurance company or bank, and just sign up. And a SEP would be the same thing. You'd go to a financial institution because, again, you know, ultimately it's an IRA. But in a qualified plan, you have to have a plan document. There's different ways to do it. You can do a real simplified one, add an investment company, or you can have one that's specifically designed for you, which is something that we do. And there you can take advantage of all the different laws and different ways of trying to do things to, you know, accomplish the goals you have in setting the plan up.
Right. So, and some of these, like if you go through a brokerage or a Vanguard or whatever, they've got some cookie cutter plans that are available.
Yeah, they're you have to realize that, you know, they're going to make sure that it's something that you leave your investments only with them, and it's going to be very limited in the options because they want it to be very easily administered and that type of thing.
Right. So the advantage is, or at least the appeal, maybe I should say, is that the cost that you see for those plans.
Well, the cost for those is low cost.
Yeah, it's very low cost as opposed to having a custom type plan.
Right. Well, one thing that I recently came across was they put the responsibility on the employer to know how to fill it out and when to fill it out. I recently picked up someone who didn't do their last update.
Whoops.
And because they didn't know, they didn't understand what had been mailed to them, and the brokerage house actually froze their account and won't allow them to take any money out until the plan's updated, which we're now going to go back and update the plan and have to go to the Internal Revenue Service to get approval because it's now late, because they left it up to the owner of the company to figure out how he was supposed to do it.
Right.
And so that, unfortunately, is a downside of those types of plans.
Yeah. So somewhere somebody needs to be sort of looking over the employer's shoulder, whether it's their CPA or attorney.
That's what we
or
try to
whatever.
help people to do,
Yeah,
is to make
yeah.
sure they're meeting all the timing
and
keeping everything up to date.
And with a company like yours, things can be more customized. There are ways that you can design these plans to try to get more benefits for the owners of the business.
Correct.
And so forth.
Correct.
And so by working with a company like that, there's a possibility of them getting more of those retirement dollars that the company pays in coming out to them.
Correct.
And so that's something that many, especially small business owners, are really interested in.
Yes, yes.
Yeah. All right. Well, why don't we talk for a few minutes about the non-discrimination and top-heavy rules and how they interrelate with plan administration?
Well, in any of the plans, there's a definition of a highly compensated employee. And basically the testing, and there's a variety of testing, whether it's 401k or it's how many people you cover that are eligible to be in the plan out of the workforce. But it's comparing the percentages of the highly compensated that have a benefit to the non-highly compensated that have a benefit. And like I said, there's a variety of tests that have to be done, and you have to fall within the parameters that the IRS regulations say you have to fall within. And some of those, we get into more sophisticated plans, it's very important to make sure all the testing's done right so that you can take advantage of certain things, but make sure that you're staying on the straight and narrow.
Right. So anyway, so each year, as part of the administration, and some of it's related to the tax preparation process and so forth, but also like when you're looking at these 401ks, you're looking at the contributions that are going in for each employees, and if things are out of kilter, sometimes some of that money actually has to be returned back
to the people that are highly compensated. Yes.
Yeah.
So
anyway, so this is something where you really do need somebody to be watching that. This is not a do-it-yourself project in most cases, unless you got an awful lot of money.
I'm biased, but no, I don't think so.
Okay. Okay. Now, some of these plans actually require audits of the plans. Isn't that right?
Yes. If you have over 100 participants in a plan, then the actual form that goes in at the end of the year has a requirement for a CPA accountant's audit to be to accompany that.
Right. So this is sort of like a financial statement audit.
Correct.
And so a CPA firm has to be hired, and they go in and basically do confirmation, looking at basically to make sure that everything's there that you say is there, and so forth, and that things are being operated in a kosher way, if you will, or properly. And so anyway, this is an additional expense, though, that you have to be aware of when you have more employees, that it's going to cost more. These plans do have some definite expenses, and as we said, one in designing the plan, making sure that it's kept up to date. In some cases, you may have to do special filings with the IRS and get their approval for some of the things that you're doing. And then these financial statement things, and financial statement audit, and issuing reports to the employees about what's going on with their accounts.
Right. And that's increased significantly. There's new regulations that have gone into effect with the U.S. Department of Labor regarding participant information. And by August 30th, if somebody's in a participant-directed account where they direct their own investments, there's a significant amount of information that needs to be provided from the employer to the plan participants.
Okay, so maybe we'll get into that a little bit more in just a couple of minutes, because we're going to talk a little bit about current issues and trends, and I think that's a significant one. Well, maybe we should just go ahead with that a little bit. So one, we've got these new reporting requirements.
Correct.
And as I understand it, there's some real disclosure rules that haven't been there before. There's been maybe some hidden fees and some other things that employees haven't known about.
Correct.
I would think that, for example, we've talked about the brokerage companies that have been doing some plan administration. You haven't seen necessarily very much expense. We may suddenly see maybe there's some expenses people haven't been aware of before.
Right. I mean, there's been expenses within plans that may be at a large vendor company that handles everything, the investment side, the administration, the record keeping, but it's never been broken out for the employers or the employees. So for an employer to be able to tell, what are the fees that are being charged, so I can compare it with other firms, and also disclosure to the plan participants, so that they know that if I'm in Fund A, there's an expense ratio that pays 1%, or if I'm in Fund B, it pays 0.5% as far as the fees charged for managing that, the investments in that particular fund. So that way employees and employers can try to make the best decision for themselves, what they think is best in cost and what they're getting for it.
Right. And I mean, this is something to be aware. So again, when I had a plan previously, the choices that were given to us, again, it was through a brokerage company. Well, one, there were an awful lot of choices there. A lot of them didn't feel like they were that great.
Right.
Anyway, and most of them had some sort of a back-end fee that were built into them. And so now I'm involved in another plan with an independent, well, you guys are administering, so and I have another investment manager that's helping me with it.
Right.
And so anyway, so we have more independent choices of the funds and investments that we make with the plan. Okay. Well, how about, what other issues do you see, and particularly maybe looking ahead a little bit with tax reform and so forth?
Well, basically, I mean, I think everybody can probably agree, no matter what anybody talks about, that Congress probably is not going to do any tax reform this particular year. It's an election year.
This is 2012. By the way, it's July 24th, 2012. Okay, right. Go ahead.
And so, those types of things just aren't going to happen until everybody goes through the election cycle. So, but the forecast is that there is going to be some sort of tax reform happening in 2013. One of the ideas that's being floated around, which I don't particularly think is good, is they're talking about lowering potentially those limits that we described up to 50,000 down to 20,000.
That would be really serious for a country.
Right, and after I said that there's so few people that have not saved a significant amount of money, that 20,000 would be below what a 50-year-old could put into a 401k with their catch-up. It would be less. And then there would be no room for an employer to put any money in. Or the employer puts money in and then the employee can't put money in. So I just think it's deleterious to take that down that low.
Yeah, in a word, it's nuts. Okay, so we'll see what happens when they actually get. Well, we know that there's going to be a huge wrestling match.
Yes.
And so it's anybody's guess as far as what's going to happen with tax reform and so forth. But it does seem like, with all the spending that's been going on and so forth, the deficits that we've been having, that there are going to be pressures.
Yeah, a variety of pressures
going on in Congress related to funding, finances, and so forth. And meanwhile, nobody wants to raise taxes, but how do you do it when you don't? I mean, so who knows?
I know.
Okay. Excuse me. Well, we only have a few minutes left, believe it or not, but maybe you can talk for a few minutes about how companies, again, like yours, third-party plan administrators, help as compared to like the brokerage companies or the other.
Well, I mean, we try to make sure that we're in contact and help, manage the administration side of all the plans all the way through, and keep in constant communication with the employees. If employees have a question, they can call and ask us, and we'll explain to them how their plan works. Or how a distribution's done if they're taking a distribution out of the plan. and with the employers, we try to keep them up to date as to what all the advantages and limits and different combinations that are out there, and ideally try to listen to what the employer's trying to do. There's a different reason possibly with different employers as to what they're trying to accomplish with the plan, and we just try to keep up to date so that we can give that correct answer to the employers. Helps them manage their plan and for their employees.
Right. Now, we only have a couple minutes left. Well, I guess I just wanted to highlight for just a moment that there are some forms that are required to be filed with the IRS related to these.
Yes.
And maybe we can talk about what due dates are and that sort of stuff.
Yeah, there's an annual form that needs to be turned in called the Form 5500. Goes to 3 different government agencies in some cases. And it's just a basic report of what went on in the plan for that particular year. It's like any other kind of tax return. And it's due 7 months after the end of a plan year, unless you're on extension. There's no income tax implication one way or the other, but if you're late, they have penalties for not turning it in on time.
Right.
Yeah,
they have some pretty nasty penalties that apply to all this stuff too. So that's why you.
Well, yeah, otherwise maybe people would never turn it in. So they have to have, they have to have something to make sure everybody turns it in. But it's an informational return. It's also what's used by the government to decide who's going to be audited.
Okay. We only have a few moments left. Maybe you'd like to throw out a final thought, and then we can just wrap this thing up.
The final thought is that, it's just very important to make sure that the plans that you have are run properly, because you want to make sure that it takes care of you if you're the business owner. You want to make sure it takes care of your employees so that, they receive the retirement that they deserve also.
Okay. Phil, thanks for being my guest today.
Sure.
Folks, this area of retirement planning really is very, very important. And so I hope that we've stimulated your thinking a little bit, and that you'll investigate more if you've got a small business. And we'll see you next time on Financial Insider Weekly.